Another day, another story. The Enron scandal was one of the most notorious corporate fraud cases in history, which unfolded in the early 2000s. Enron Corporation, a Houston-based energy company, was once considered one of the largest and most innovative companies in the United States. However, it was later revealed that Enron had engaged in widespread accounting fraud and deceptive practices to conceal its true financial condition. Here are some key details of the Enron scandal. Manipulation of financial statements. Enron used complex and deceptive accounting methods to manipulate its financial statements, creating the illusion of profitability and financial health. They employed special-purpose entities, SPECs, to hide debt and losses from its balance sheet, giving a misleading impression of the company's financial performance. Off-balance sheet transactions. Enron engaged in off-balance sheet transactions, which were undisclosed to shareholders and regulators. These transactions allowed Enron to shift debt and losses off its books, providing a distorted view of the company's financial position. Use of mark-to-market accounting. Enron employed aggressive mark-to-market accounting, whereby they recorded anticipated future profits from long-term contracts as current income. This allowed them to inflate their reported earnings and deceive investors about the company's profitability. Lack of transparency and disclosure. Enron failed to disclose critical information about its financial dealings, partnerships, and liabilities. The company deliberately concealed its true financial condition, preventing investors and analysts from accurately assessing the risks associated with Enron's operations. Collusion and conflict of interest. Enron's top executives, including CEO Jeffrey Skilling and CFO Andrew Fastow, were involved in fraudulent activities. They manipulated financial results, pressured employees to meet unrealistic targets, and benefited personally from Enron's fraudulent schemes. Additionally, Arthur Andersen, Enron's auditing firm, was found guilty of obstruction of justice for destroying documents related to the scandal. Bankruptcy and fallout. In late 2001, Enron's financial irregularities were exposed, leading to a rapid decline in the company's stock price and a loss of investor confidence. Enron filed for bankruptcy in December 2001, resulting in significant financial losses for shareholders and employees. The scandal also had broader repercussions, leading to the collapse of Arthur Andersen and sparking widespread public outrage over corporate fraud and accounting practices. The Enron scandal served as a wake-up call for regulators, investors, and the business community. It highlighted the importance of strong corporate governance, ethical practices, and transparent financial reporting. The fallout from the Enron scandal prompted regulatory reforms, such as the Sarbanes-Oxley Act, aimed at improving corporate accountability, enhancing financial transparency, and strengthening auditing standards. The Enron scandal had far-reaching impacts on various aspects of the business and regulatory landscape. Here are some of the key impacts of the Enron scandal. Collapse of Enron. The scandal resulted in the rapid downfall of Enron, which filed for bankruptcy in December 2001. Enron's collapse led to significant financial losses for shareholders, employees, and creditors. Thousands of employees lost their jobs, and retirement savings tied to Enron stock were wiped out. Loss of investor confidence. The Enron scandal severely damaged investor confidence in the corporate sector. The revelation of widespread accounting fraud and deceptive practices eroded trust in financial reporting, leading to increased skepticism among investors and a decline in the valuation of many companies. Regulatory reforms. The Enron scandal prompted significant regulatory reforms to address the weaknesses in corporate governance and financial reporting. In 2002, the U.S. Congress passed the Sarbanes-Oxley Act, SOX, which introduced stringent financial reporting, internal control, and corporate governance requirements. SOX aimed to enhance transparency, accountability, and integrity in corporate practices. Strengthened auditing standards. The Enron scandal exposed flaws in auditing practices and the potential for conflicts of interest. It led to increased scrutiny of auditors' independence and the need for more rigorous auditing standards. The scandal led to the demise of Arthur Andersen, Enron's auditing firm, and prompted reforms to enhance auditor independence and accountability. Heightened corporate governance standards. Enron highlighted the importance of robust corporate governance practices. Companies and boards of directors recognized the need to prioritize ethical behavior, transparency, and accountability. There was an increased focus on board composition, risk management, internal controls, and the role of independent directors in overseeing corporate activities. Impact on energy markets. Enron's fraudulent practices and market manipulation had broader implications for energy markets. The scandal raised concerns about the reliability and transparency of energy trading and led to increased regulatory oversight and scrutiny of energy companies. Public outrage and repercussions. The Enron scandal sparked widespread public outrage over corporate fraud and executive greed. It brought attention to the ethical and moral obligations of corporations and executives towards their stakeholders. The scandal led to public demands for greater corporate responsibility and stricter regulations to prevent similar abuses in the future. The Enron scandal served as a catalyst for significant changes in the corporate, accounting, and regulatory landscapes. It highlighted the importance of ethical conduct, transparency, and accountability in business operations. The reforms that followed sought to restore investor confidence, enhance financial reporting practices, and strengthen corporate governance to prevent future fraud and protect the interests of stakeholders. Thanks for watching.